What if there was an actual formula for consistent double-digit growth? Well, today, we're going to break down a company that claims to have done just that, to have perfected it. We're talking about the industrial tech leader, AMETEK.
I mean, if you're a long-term investor, this is really the million-dollar question, right? How do you find a company that isn't just a one-hit wonder, but a true machine built for sustained growth, year after year, decade after decade? Well, AMETEK believes they've cracked the code. They call it the AMETEK Growth Model. And that is exactly what we're going to dig into today. We're going to see if this core strategy of theirs is really the formula for success they say it is.
All right, so first things first, what is AMETEK? They're what you might call a company of niches. At its core, it's a company built on a really specific and, frankly, a very powerful idea: dominate the small pawns.
So what does that mean? Well, they're not trying to be everything to everybody. AMETEK's whole game is to find these small, super specialized, kind of complex markets and then just become the absolute undisputed leader in them. The big fish in a small pond. You can almost think of them as a collection of a bunch of highly profitable, little niche businesses all rolled into one.
The whole company is basically split into two main parts. First up, you've got the Electronic Instruments Group, or EIG. This is the big one, the primary profit engine. They make all sorts of advanced testing equipment. Then you have the Electromechanical Group, or EMG. They focus more on things like automation and motion control. Now look, both are important, but if you're an investor, the one you really need to watch is EIG. That's the powerhouse.
Okay, let's get to the real core of the story here, the four-pillar growth engine. This isn't just some marketing slogan. This is the company's operating system, and it is laser-focused on one single goal.
And what's that goal? It's pretty ambitious, actually. They're aiming for double-digit growth in earnings per share, not just once in a while, but over the entire business cycle. It's a really systematic, repeatable process that pretty much guides every single major decision they make.
So how does it actually work? Well, think of it like a four-part cycle. Step one, they are absolutely obsessed with operational excellence. I mean, squeezing every last drop of efficiency out of their businesses. That, of course, generates a ton of cash. Step two, they take that cash and use it for strategic acquisitions, buying up other awesome little niche companies. And then steps 3 and 4, they grow everything, their original businesses and the new ones, through global expansion and constant new product development. You see how it works? It's this self-reinforcing flywheel that just keeps spinning faster and faster.
All right, so now we get the how. Let's talk about the why. Why would an investor get so excited about a company like this? Well, the bull case here is all about building what you might call a fortress of profitability.
See, AMETEK doesn't just compete. They build these deep, wide moats around their businesses. Their products are incredibly complex. They're often mission-critical for a customer's own product to even work. And here's the kicker. Once their component gets designed into a system, think like an airplane engine or a high-end medical device, it is so difficult and expensive to replace. This gives them incredible staying power.
And this quote just says it all. The cost of our component is small, but the cost of its failure is catastrophic. This right here is the secret to their pricing power. I mean, think about it. When your tiny, maybe inexpensive, little part is the one thing stopping a multi-million-dollar piece of equipment from failing catastrophically, yeah, customers aren't going to haggle over the price. They're going to pay for reliability every single time.
So what does all that pricing power actually look like on the bottom line? It looks like this number, a 31% operating margin in their main division. Let me put that in perspective for you. For every single dollar they make in sales, 31 cents drops straight to operating profit. That's an absolutely elite level of profitability for an industrial company. It's the clearest proof you can get that their whole niche strategy is working exactly as planned.
And that incredible profitability, well, it generates just a torrent of cash. In 2024, we're talking over $1.8 billion in free cash flow. And listen, this isn't just some number on a spreadsheet. This is the high-octane fuel for that growth flywheel we talked about. This is the cash they use to go out and acquire the next great niche business and just keep that whole machine turning.
And just to put that in perspective, let's look at them next to some other high-quality industrial companies like Fortive and IDX. You can see right away, AMETEK's operating margin just stands out. They're simply flat out better at turning sales into actual profit. That right there is the power of their niche strategy in action.
So what's the ultimate payoff for an investor who bought in and held on? It's this number, an 18% annualized return, sustained over 2 decades. I mean, that doesn't just beat the market, it absolutely crushes it. We're talking nearly tripling the return of the S&P 500 over that same period. This is the textbook definition of a long-term compounding machine. Okay, that is a pretty compelling bull case. But every great story has a counter-argument. So let's look at the bear case. What are the potential cracks in the foundation? What are the risks here? What could go wrong? Really, the central concern for any bear, any skeptic, it all boils down to one simple question. Everyone knows this is a high-quality business, but is the price you have to pay for it just too high? Have investors already paid for all that past greatness, and maybe then some? So if you look at a common valuation metric, the price-to-earnings ratio, you can see exactly where this concern comes from. AMETEK, you can see, trades at a pretty clear premium to a close peer like Fortive. What this means is the market is already pricing in a ton of future success, and when that happens, there's very little room for error.
So the key bear arguments really boil down to three main points. First, that premium valuation. It means any stumble, any slip-up could cause the stock to fall pretty hard. Second, macroeconomic cyclicality. For all its diversification, this is still an industrial company. A big global recession is going to hurt their business. And finally, there's the law of large numbers. As AMETEK gets bigger and bigger, it just becomes that much harder to find acquisitions that are big enough to meaningfully move the needle on their growth.
And there's one final data point that investors really need to consider. It's something the bears will definitely point to.
Okay, so here it is. If you look at insider trading activity over the last 2 years, you see a pretty consistent pattern of stock sales by senior executives, and at the same time, a complete absence of any open market purchases by those same insiders. Now, to be fair, there are lots of perfectly good reasons for executives to sell stock, but a complete lack of any buying, well, that could be seen as a signal from the people who know the company best that maybe, just maybe, they view the stock as fully valued.
So all of this brings us right to the investor's dilemma, that core conflict between quality and price.
So here's the final showdown. The bull case is clear. This is a best-in-class compounding machine with a proven, repeatable growth model and some seriously durable competitive moats. But the bear case is just as clear. This is a premium price stock, it's got inherent cyclical risk, and its valuation demands near-perfect execution going forward. And that leaves us with the ultimate question for any investor looking at this company. Is paying a premium price a fair cost for a premium business? We know AMETEK is an incredible company, but the real debate, the real question is whether paying today's price is a smart bet on the future or just overpaying for yesterday's incredible success. And answering that, well, that's the art of investing.